Anil, do you know cost affects the business?
Cost? What kind of cost, Divya ma'am?
Cost is the monetary value of resources like material, labor and overheads used in the making of a product or delivery of a service. In many cases, there may be no material involved in the delivery of a service. So, the involvement of cost in business varies by the nature of the business. Cost can be classified in various ways. Here are some of the ways. Some costs are based on association with cost object. It is also called direct versus indirect costs. Some costs are based on reaction to changes in activity. It is also called fixed versus variable costs. Some costs are based on classification on financial statements. It is also called expired versus unexpired costs.
Ma'am, can you explain how each of these costs work in business activities?
Sure. Let me explain them to you one by one. Direct versus indirect costs are based on their association with different cost objects. A cost object is an item or object for which costs are measured separately. Here are some common types of cost objects. Output is the most common way of defining cost objects. It is based on a business's output because a business would want to know the cost of producing or creating its output. Operational is based on department within the business or a specific operation or process. For example, a business could measure the cost of a customer service call. Business relationship is based on an entity outside the business. For example, cost could be aggregated for each supplier or customer. Direct costs are those that can directly and easily be traced to a cost object or objects. Indirect costs are those that cannot be economically traced to a cost object and hence these costs must be allocated to a cost object or objects.
Earlier, we had discussed about the business of Raju, the thela wala. How does cost object works in his case, ma'am?
Yes, cost object may work in many ways when it comes to Raju, the thela wala. Cost object for Raju, the thela wala, could be seasonal vegetables and non-seasonal vegetables, or green vegetables like beans or lady's fingers, root vegetables like potatoes or carrots, and other types of vegetables. If he starts selling fruits also, cost objects could be vegetables and fruits. The cost of fruits and vegetables are direct costs because they can be traced to the two cost objects, fruits and vegetables, respectively. Let's say that Raju the thela wala buys tea during winter and nimbu pani during summer while working at his thela. The costs of tea and nimbu pani are indirect costs because their costs cannot be traced back to the two cost objects, fruits and vegetables. So, the costs of tea and nimbu pani must be allocated to the two cost objects.
There are also fixed versus variable costs. How does it works, ma'am?
Let me tell you how. To understand how costs change with output, it is useful to classify costs as fixed and variable costs. Costs that do not vary in the short term regardless of changes in output levels are called fixed costs. Costs that vary with the output levels are called variable costs. For Raju the thela wala, the cost of his thela is fixed because it does not depend on how much fruits and vegetables he sells. The cost of fruits and vegetables sold is variable because it varies with how much fruits and vegetables he sells.
Ma'am, does all inputs in a business can be converted to sellable outputs?
Yes, of course. Let me elaborate the degrees of conversion to you. Almost all businesses convert or modify inputs to a sellable output. Inputs typically consist of raw material, labor, and overheads. The cost of conversion is dependent on the degree of conversion done by a business. You could think of 3 degrees of conversion: low, moderate, and high. Providing convenience to customers in terms of location, timing, and variety with almost no physical conversion of inputs is termed as a low degree of conversion. In the example of Raju the Thelawala, he provides ease of access in terms of location and timing to fruits and vegetables for his customers. Some amount of visible conversion to the output is termed as moderate degree of conversion. For example, Raju the Thelawala removes unnecessary leaves, roots and stalks, washes and packs the fruits and vegetables in plastic before selling them to his customers. A major transformation from input to output is termed as high degree of conversion. An example of this would be a two-wheeler company like Bajaj Motors or Hero MotoCorp. They take inputs consisting of various parts of a two-wheeler made out of metal, plastic and glass and convert it to two-wheelers motor vehicles. Retail companies like Reliance Fresh, D-Mart, Big Bazaar have low to moderate degree of conversion. Manufacturing companies like Bajaj Auto, Hero MotoCorp, Amul, Asian Paints or Bombay Dyeing Textiles have a high degree of conversion.
What about expired versus unexpired costs? How does it works in business, ma'am?
Expired versus unexpired costs calculation helps to check how the capital is being used. To determine if a cost should appear on the balance sheet or income statement, it is useful to think of costs as expired and unexpired costs. Expired costs are those that have been completely consumed or the benefits from which have been received by the business. Unexpired costs are those that have not been consumed fully as yet and have some residual value. If you look at the P&L statement, you will notice that all expenses are represented as expired costs, whereas assets on the balance sheet represents unexpired costs. In the case of Raju the Thelawala, the cost of fruits and vegetables sold are expired costs, as they will show up as cost of goods sold, simply called COGS on the P&L statement. The cost of fruits and vegetables not sold as yet are unexpired costs, as they will show up under inventory on the balance sheet. The annual depreciation cost of his thela will be expired cost and hence recorded on the P&L statement. The value of his thela net of depreciation cost will be the unexpired cost and hence recorded on the balance sheet. This unexpired cost of the thela will reduce by the annual depreciation cost every year on the balance sheet. If we assume a 10-year useful for the thela and an initial cost of rupees 10,000, its unexpired cost will be rupees 9,000 after 1 year, rupees 8,000 after 2 years, and its unexpired cost will be 0 after 10 years. Product costs are the key determinants of the cost of goods sold or COGS, which appears on the P&L statement. They represent the cost of items or services used to generate revenues. The 3 main components are direct material, direct labor, and overheads. Let's discuss about each of these factors. It is the cost of any material directly used in the production of the output. For example, for a two-wheeler, it would include the costs of engine, fuel tank, shock absorbers, mirrors, handlebar, wheels or tires. Direct material costs are significant for manufacturing companies like Hero MotoCorp, Amul or Asian Paints. Direct material costs are low or insignificant for service companies like Infosys, Wipro, State Bank of India or ICICI Bank. Direct labor costs refer to the cost of individuals involved in manufacturing a product or delivering a service. The cost includes salaries, bonuses, insurance, pension benefits, earned leave paid to the individuals involved. It typically does not include overtime costs paid to the individuals. It does not include salaries of executive, salespersons, commissions paid to the sales team, advertising, utilities paid for the administrative building or any other structures constructed for business purpose. These are not directly involved in the manufacturing of a product or delivery of a service. While direct material cost and direct labor costs are direct costs, overheads costs include indirect costs incurred in the manufacturing of a product or delivery of a service. For example, in the manufacture of a two-wheeler, it will be very difficult to keep track of the exact amount and cost of glue and exact number or cost of screws used. The cost of glue and screws will be indirect costs. But the cost of these must still be included under product costs. To know how these costs are calculated, we need to know about cost allocation. As we have already discussed that indirect costs like overheads cannot be easily traced back to a product or service. Hence, businesses need to allocate these costs to each product or service or broadly each cost object. Cost allocation is a method through which a business allocates or distributes an indirect cost across various cost objects. There are 4 parts to cost allocation: cost pool, cost objects, cost driver, and allocation volume. Let's discuss about each of them. Cost pool. This is the total indirect cost that needs to be allocated across cost objects. Cost objects, as we already know, is divided into direct and indirect cost. Cost driver is defined as some attribute or characteristics that we can measure for each cost object. Allocation volume is the aggregate of the cost driver amounts across all cost objects. The steps in cost allocation are determined by overhead rates. The overhead rate is the amount in the cost pool divided by the allocation volume. To know the allocation of cost, multiply the overhead rate by the number of cost driver units in each cost object.
Earlier, we had discussed about the business of Raju, the Thela Wala. How does cost object works in his case, ma'am?
Yes, cost object may work in many ways when it comes to Raju the Thela Wala. Cost object for Raju the Thela Wala could be seasonal vegetables and non-seasonal vegetables, or green vegetables like beans or lady's fingers, root vegetables like potatoes or carrots, and other types of vegetables. If he starts selling fruits also, cost objects could be vegetables and fruits. The cost of fruits and vegetables are direct costs because they can be traced to the 2 cost objects, fruits and vegetables, respectively. Let's say that Raju the Thela Wala buys tea during winter and Nimbu Pani during summer while working at his thela. the costs of tea and Nimbu Pani are indirect costs because their costs cannot be traced back to the two cost objects, fruits and vegetables. So, the costs of tea and Nimbu Pani must be allocated to the two cost objects.